har jo vært noen spørsmål om vi skulle ha denne episoden på engelsk eller altså dansk-norsk da. Og vi har konkludert litt sånn behind the scenes at denne episoden blir spilt inn på engelsk.
Ja, tenker det er tryggest det. Så kan du bare kjøre, kanskje.
Skal du bare kjøre i gang?
Ja.
Denne podcasten og innholdet skal ikke anses som investeringsråd. Hensikten med podcasten er å bidra med informasjon om finansmarkedene og selskaper. Podcastvertene er selvlærte hobbyinvestorer og ikke finansielle rådgivere. Informasjonen som gis i podcasten utgjør kun våre personlige meninger. Hvis du legger vekt på noe du har hørt her, gjør du det på egen risiko. Verdipapirer som diskuteres i podcasten skal ikke forstås som en anbefaling til å kjøpe, holde eller selge nevnte verdipapir. Podcastvertene kan være direkte eller indirekte eksponert mot verdipapirer som diskuteres.
Okay, welcome to the show. We have a returning guest today, Mudsen from Denmark, standing star in the retail investor community, very famously taking big bets with the high conviction behind them. Welcome back.
Thank you, and thank you for the very kind introduction.
Yeah, we love you, Mudsen. You're so much great insights and a lot of laughter as well. So that's good.
Of course, yeah, perfect. I'm good to be back. And we have an exciting show today. I've seen the agenda before, so you sent it to me yesterday, and I think we have some great topics to discuss here.
But before we get started, sorry, Kenneth, I just have to share this with the crowd and the listeners and people who know Mudsen through the Discord. Congratulations on your firstborn child, Mudsen. That's a great feeling.
It is, but also a very tired feeling. I must say, I've heard people say before that you will be exhausted when you have a firstborn child, but yeah, now I know they really mean it. I'm on two weeks leave now, so I'm not working. So I'm just home with the kid, my wife as well. But yeah, I'm feeling it for sure.
I hope your wife and child is doing fine. Girl,
Yeah, it was.
Yeah, that's I remember the first time I held my firstborn child. No feeling in the world can explain or try to describe the feeling. So just take on the emotions, Mudsen, and enjoy the lifelong ride.
Yeah, thank you. I think this is actually what is kind of scary about it, but also what makes it, incredible in some way, that this is like for real, it's a permanent thing. And it does feel very surreal. So I agree with the feeling that you had. I've had the same.
Yeah, it's the most beautiful evolution. Okay, let's go. So one of your quotes, or one of your famous quotes is "Know what you own," right? So it's based on the famous Peter Lynch quote, which I've gathered. So I thought I would just read it out. And he says that if you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. Stocks aren't lottery tickets. Behind every stock is a company. If the company does well over time, the stocks do well, and vice versa. You have to look at the company. That's what you research. So, what's know what you own for you, Mudsen?
Well, actually, as you just mentioned, it is a quote by Peter Lynch. So, who am I to argue with him? What I mean about it is not different than what he does. You read a portion of what he said at the time, but he actually goes on and says a little bit more. He talks about, how people do research when they want to buy a refrigerator or buy a car or even like a TV or any other electronic equipment. They use a lot of time doing research because they want to find the best deal, or they want to know which TV has the best quality and what fits their needs. And I see that in my everyday life, and people I know, often ask me about like what should I buy here, what should I do with this, you know. So every time we want to buy something in our personal life, we always seek advice from family and friends or other professionals. But for some reason, when it comes to the stock market, um, what I have experienced is that a lot of people don't do the necessary research before buying. Probably if you guys are on social media, you would have seen by now some famous or like very often seen questions like, why is this going up? Why is this going down? Very typical questions on an amateur level, but it just describes exactly what the quote is all about. Like these people are asking those questions because they don't fully understand the dynamics of what they own, like what kind of factors have an influence on the stock price, what dynamics in the company environment are moving the stock price. All of these kind of things is something that I think people should understand before owning a company or a stock. Yeah. So when I look at it, it's more of do the necessary research before you buy the stock. You will have a not necessarily a 100% understanding of the company, but a decent basic fundamental understanding of what this company is about, what do they do, where do they operate, and what kind of business dynamics or market dynamics move the company's earnings. Because we want to like try to assess what is going to influence our company's performance here, both in the short term but also in the long term. So we need to have an understanding of competitors, regulation risk, all of these kind of things that could have an influence on the company that you are buying the stocks of.
So,
So,
so when you see a stock on Discord, people are talking about it, and you see the nicknames debating the stock are known for picking really good value in the market. What do you, how do you assess a company? What do you look for, and how? What will it take for you to buy that company when the initial idea isn't yours?
So I guess the answer to the question depends on whether or not I know the company beforehand or not. You know, sometimes people come up with a ticker code or an idea of a stock that I haven't heard of before, or I haven't never done any deep dive research on the company. And that approach would be kind of different in like compared to a company that I know because I use the products or I have just heard about it many times before. Maybe I did like an initial screening on the company before. So my approach or the amount of time and energy I would spend doing research would vary a little bit depending on whether or not it's a completely new company or not. But I can say that if I have a completely new company that I've never looked at before, one of the first things I do is actually, it seems kind of simple, but I don't know if you guys do this as well. But one of the first things I do is actually pull out like just search on Google um, the ticker code and the stock so I can see the graph and then just put on the max view to see what it has done long term. Even though it doesn't tell me much, but it does kind of tell me what kind of company am I looking at. You know, is there some cyclicality to the stock price? Is it a steady grower, just exponentially growing over time? How has it done over recent years? Are there any, how can I say, like if you look at the long-term graph, is there any point on that graph that is very different, kind of like an outlier? Because that would tell me that this is maybe something that I would need to look into. What happened here? So my very first initial screening of a stock would actually just be to look at the stock price because that would tell me how the company has done. I know we're going to talk a little bit about ATD later in the show, but if you look at a stock chart of ATD, it tells me that the company has been doing incredibly well for many, many years because the stock price, the chart of the stock price is just linear. You know, it's like almost always in all-time highs or very close to all-time highs. And over the long run, I have the theory, or it's not my theory, but I totally believe in it, that the stock price will follow the fundamentals and the earnings. So when I see a stock chart like ATD, which is just going straight up for many, many years, it tells me it's a great company.
So how did you find the company ATD?
A friend of mine called Farok. He mentioned it the first time. Uh, yeah, and
Yeah.
then I did what I just talked about here. When you mentioned it, I just pulled out the stock chart, and immediately I thought, okay, this is a great company. I need to look into it a little bit more here. And then I started doing some more research or deep dive. And
Yeah.
obviously, the next step would be to look at the fundamentals of the company, look at the reports over time. I actually prefer, before doing like a real deep dive and reading like annual reports, I'd always like to just pull out the investor presentation from the website of the company, because it gives you like an overview of the company in a very simple manner, like visually intriguing. It shows you like the performance, what kind of product they have, all of these things. So when you read the investor presentation, which is not as long as an annual report, you get a basic idea of what kind of company is this. So this is always the second thing I do, actually.
So how do you reflect on the investor presentations? Let's be fair, no CEOs, CFOs, or other company has a management that's gonna tell you their issues with a company, the debt levels and so on. They will always focus on the positive things. How do you filter out what's good and what's bad, and how do you call bullshit, if I'm allowed to say that?
Yeah, and I completely agree with you that, of course, an investor presentation is what the name actually says. It's a presentation for investors to make investors believe in the company and feel like they want to invest in this company. So obviously, it's going to be positive things, but I'm not of the belief that they cheat with the numbers or anything like that. And often there are a lot of numbers in the presentation as well. So, CAGR over time, debt levels also often occur there. A lot of things actually go on there, but it's not as an isolated thing. So when I look at the investor presentation, I see what kind of information I get from that, and then I take it a step further and look at the actual balance sheet of the company. Because for me, actually, one of the biggest things about investing that I appreciate a lot is to be able to sleep well at night. And the only way I can do that is by knowing that I own a company that is financially stable, very safe, very strong as well, and has manageable debt levels. So there's no risk of them going bankrupt anytime soon. When those are in check, I know like now I can sleep very safely and comfortably, because I know that I'm not going to lose 100% of my money. So that's like the first criteria that I have. But of course, I don't want to lose 50% of my money either. So some more research needs to be done here. But I just want to make sure first and foremost that this company is strong fundamentally from a financial standpoint, and there's no risk of bankruptcy anytime soon.
Yeah, that's always a good idea. So at what time do you look at the product portfolio, or what they do?
Yeah, that's while I look at the investor presentation, that's something you will get an idea of already there at that point. But if I have done this initial screening, I have a basic understanding from looking at the investor presentation of the company at this point. I've looked at the financials, and they're telling me this is a good company, strong financially. That's where I will take my last approach, if I can put it like that, of looking at the company from more of a competitive standpoint, or more like a holistic approach, and not based on numbers. So like, what is their brand value? How strong are they looking? What are customers saying? What products do they have in the pipeline? All of these things that will tell me that this company has some growth initiatives going forward, and they're trying to execute on them. It's not something that is easy to do, because as Faruk was talking about a minute ago, the management can always try to paint a positive picture. And I think the only way to really know if the management are talking are serious about what they're saying, and actually working towards their goals, is to look at what they have said in the past, and look at it today and see if some of that have come true, if they have done what they have said. It is, it's not an easy task, to be honest, but it is manageable. And of course, it's easier if it's a company that you already know, maybe from like your everyday life, if you've seen it somewhere, if you already use the products, that will give you a much better understanding of, where the company is, like the quality. Do you like the products? If you like it, then probably many other customers will like it as well. That's a great way to start.
Yeah. Yeah, it sounds great, but it's really a lot of work, to be honest, to check, at least if you're gonna double check the management of what they've said in the past, and then
Yeah,
cross check with
yeah,
what they have done.
yeah. It is. But most of the companies that I invest in are like big companies who have proven the test of time. So it's not companies that have IPO'd in the last couple of years. They have been there for a long time. And as I started by mentioning the stock chart, um, I don't want to put on such a big emphasis on the stock chart, but if the company has grown the stock price for 10, 15, 20 years, even through a financial crisis in 2008, a pandemic, all of these things, that tells me that the management is great at executing and can navigate the different environments in the market.
Yeah.
So,
Yeah, I
yeah.
agree fully, and like the best way to assess that's one of the tests I do when I look at a new CEO. If there's a new CEO in one of my companies, I always go back and see where did they come from, and how did the stock do if they were CEO of some other company.
Yeah, I think that's a great approach actually, because in the short term, I think investor psychology maybe weighs a little bit more, or can weigh a little bit more on the stock price. But as I mentioned in the beginning, over the long run, over 10 years, the stock price will follow the earnings. So, if regardless of what happens in the short term, if the management is executing on the strategic initiatives and performing well, I think the stock will be, or the company will be rewarded over time with a higher stock price. So I think it's a simple but yet effective way to assess what kind of company you're looking at, just by pulling out the max chart of a stock.
Yeah. So what do you do with business models or sectors that you don't have any knowledge about? Like for me, I can say that I don't really understand the Medicare stuff. So it's difficult for me to understand what is a good a good potential for medicine or stuff like that. So that's why I'm very careful about those kinds of stocks. Uh, do you stay away from stuff you don't know or understand, or do you invest in
Uh,
everything?
no, I don't invest in anything. I invest in stuff that I can understand, if not fully, then at least in the basic terms. The way I adjust for this lack of understanding is by my position sizing. So, for example, I bought the United Health a couple of months ago, um, strictly based on a fundamental level. I thought that stock was too cheap compared to the earnings growth it had at the point, and it fell like 7% on one day. This is a sector that I do not fully understand, but again, the stock performance over the long run for United Health has been incredible. And the way I adjust for this risk is just by not putting a lot of money in this. So if I want exposure to something that I do not fully understand, I try to take some chips off the table because I'm not comfortable with it. Because know what you own is a great way, but you cannot be an expert on anything or on everything. Sorry. So if you strictly invest in everything that you know, on only in stuff that you know 100%, then the pool of stocks that you can invest in will be small. So I will extend this know what you own to a little bit further out, and invest in stuff and sectors that I have basic and a holistic understanding of. So you don't need to know everything about it, but I will compensate for the lack of knowledge by taking smaller bets. So I only do big bets in companies that I have a high conviction of and that I do fully understand it.
Yeah, because you have a risk to the downside as well. Even though you have an edge in one field, if you invest in that field as well, it's kind of a double scare if you do it poorly in the stock market and fundamentally. If you work as an oil service guy, for instance, and the oil prices drop down and people are let down and so let go of, and so losing their jobs and the market outlook is poor, it would be a bad way to have invested in only oil service stocks, if you know what I mean. So the risk is to the downside. You have to. This is kind of my mantra is to be diversified.
Yeah, absolutely. I completely agree with you here. I think it was Warren Buffett that once said that rule number one in investing is don't lose money, and rule number two is don't forget rule number one. And I think actually this is very true, especially for retail investors, because to be honest, we all work hard. We have most of us have like 9 to 5 jobs or 8 to 4 jobs, so the money we earn come from hard labor, and to risk it all in something we don't fully understand, for me, it's just too risky. It's just stupid, to be honest. So if I'm taking a bet on something I can't understand fully, it will be with a small portion of the portfolio,
You
because you
have
need
a
to protect that downside for sure.
you have a great track record, Mudsen. You're one of the go-to guys that people refer to when they have questions about stocks, and everybody reads what you write on Discord, and you're such a popular figure, and that's because of your proven track record, even in sectors that are doing poorly. For instance, Simon Property Group within the real estate or REIT area, you have done really, really well. Even owning those kind of high conviction stocks in your portfolio, even though the times were bad, if I may say. How when you look at stocks, before we go to the stock specific names, but how do you differ a value stock from an expensive stock, if you know what I mean? Uh, is there a maximum price you're willing to pay regarding PE ratios, payout ratios, or PEG ratios, and etc.?
There's no maximum price, to say it like that, but I usually tend to stay away from stocks that have a PE of more than 40, forward PE of more than 40. And a PE of more than 40 can easily be a cheap stock if it's growing sufficiently. For sure, no question is about that. So if you have a stock that's trading at a 50 PE, but it's doubling revenue every single year, then it should be bought. It's a great stock and at a great price. But what I have experienced is that stocks that are trading at more than 40 PE are usually stocks or companies that are in the very early stages of their growth, or still have an uncertain path towards their end goal. So a lot of the future growth is being priced into the stock, which is why it's trading at this high multiple. And with this kind of insecurity comes volatility as well. And I don't mind volatility because you just mentioned REITs. I have been through some very, very tough times with REITs and a lot of volatility there. But I prefer like slow and steady because it helps me, keeps my emotions in check, because when you have a stock that's going like, let's say one month is up 50%, the other month is down 30%, it kind of tests you a little bit in terms of your psychology. It's very tempting to like sell your stock and take the profits if you're experiencing a 50% gain in a short amount of time. And the same way goes the other way around. When the stock is falling 30% in a month or more, it kind of makes you wonder or question what is happening. Have I misread this investment thesis? Is there something wrong that I'm not seeing here? Okay, maybe I should sell. So um, it's easier for people to do that when the volatility is very, very high. So I prefer slow and steady growers with not as much volatility. But I don't mind volatility if I know exactly what I own, which has been the case with REITs. So to answer your questions, I won't say that there's a maximum price, but what I usually tend to look after is stocks that are below 40 at the maximum, but usually in the 20-25 area. That's where I'm at. Again, it depends on what the company is and what kind of premium the company deserves. Yeah, based on the quality and the track record and the growth ahead. But I think Fortinet is my most expensive stock at the moment, which is trading at 33 forward PE or next year's earnings. So just to give you a range.
Excellent. So I was just getting back to how you analyze the opportunities. Like for instance, like you did great with the REITs during 2020 and 2021, and probably did some great buys last year as well. But that was more like a value play, right? So if you think about like the long-term possibilities and long-term opportunities, how do you go about trying to estimate what the company would do in the future? And yeah, I have some examples I'd like to run through.
Yeah, so are you talking about REITs in general or like more companies in general?
Yeah, in general, but yeah, you can take it any way you like.
Okay, so an easy way to do it is obviously I have my Excel spreadsheet with some calculations that I do for every company that I buy. But an easy way to get an estimate of where your company is expected to grow is just look at the analyst estimates. Um, I use them as my guideline, but to take a more conservative approach, I just lower the numbers. So let's say the analysts are expecting 15% growth the next 5 years. So when I run it through my calculation model, I will just put actually three scenarios. So I do like a low, middle, and high number, and the high number will be lower than analyst estimates. So this is kind of like an approach you can take to adjust for the risk you're taking on and to give yourself some kind of margin of safety. So let's say the analyst numbers or estimates don't work out because something happens. Yeah, then you have already accounted for that in your calculation to begin with. But another way to do it is also to like just do some research, do a Google search on the market that this company is operating in, and see if you can find some numbers done by research firms talking about the total addressable market. So let's say, let's just say Nike, for example, is in the sportswear. Do a Google search on apparel, sportswear, the market over in that sense. How is it expected to grow over the next 5 years? And then when you have a company you're investing in, which is maybe the market leader or one of the big boys in that sector, you can expect that this company will get some of this total addressable market growth as well. But I actually almost always use the analyst estimates as a guideline, and then I lower my own estimates and do three scenarios when I do my calculations in terms of what price should I buy this company at. Yeah.
So, do you use a DCF model or?
Yeah. I use a DCF model, and I also have another spreadsheet with the expected return. So I put in three growth numbers in the low, middle, and high scenario, and then I put in what kind of return I would like, and this return will vary depending on what company I'm analyzing here. Is it a very volatile company? How stable are the earnings and the cash flow? The more volatility and the more insecurity on the cash flow of this company, the more risk I'm taking, and I need to be compensated for that. So the discount rate I will use will be higher in that case. But usually I go for like 10-12%, which is pretty normal. So the market average in a historical sense has always been like 8-10%, depending on what market you're looking at. And I prefer to earn more than that because I'm taking on the risk of buying single stocks.
So, as you may have noticed on our Discord server, and I know a lot of people on X are also quite fond of Ulta Beauty, Lululemon, Nike, and Evolution AB in Sweden. Those are kind of stocks that that have gotten their asses kicked the last 2 years. Do you see any value in those kind of names, or do you think there is more room to go on the downside? How do you look? What do you look for in those kind of beaten up names?
I do think there is great potential in the names you mentioned, but if there's more risk to the downside, is anyone's guess, to be honest. It's impossible to say. Um, every time I see, I'm actually kind of, if I would describe myself as an investor, I would call myself kind of contrarian. So no, I don't like to do what the market does. So let's say in 2020, if I can take you guys back there, I don't know if you remember, all of the tech companies or all of those stay-at-home plays were just rallying. Do you guys remember that in 2020? PayPal, all of these kind of companies, it was just rallying so hard. A lot of the companies were going up. And I was just accumulating REITs at that time when the market was hating them. And the same happened in 2022 when the market was selling off tech in a very aggressive manner. I was just accumulating tech at that point. So I kind of like I like to go against the market, especially when I see something falling dramatically, like it has been the case with Lulu, with Ulta Beauty as well. It always gets my interest in some way. There is a danger to that approach because obviously something could be wrong with the case, with the thesis, which is why the stock is selling off massively. But that's also where the big potential upside could be found. So when a stock is falling dramatically, as has been the case with Ulta and Lulu, I do some research on it for sure. I always try to see if it's an opportunity. I did the same with Nike recently. I did the same with Starbucks. But with those two, I decided that it's not worth it. I thought it was a fair repricing to the downside. I don't think it's a fair repricing to the downside for Lulu or Ulta Beauty actually. So I expect them to go up from here in the long run. But what it does in the short term doesn't really matter for me. So if I'm happy with the price I'm paying today, then I'm just going to buy. I don't want to be sitting around waiting for like another drop because maybe I can get it cheaper tomorrow. Because probably you guys have been there, but I know a lot of people have tried it before. The psychology gets the best of you when that happens. You know, if you have, let's say, a stock is trading at $80 per share, and you say, no, it's too expensive. I want it at 60. A couple of months later, it's at 60. But why is it at 60? It's because the market has seen something it doesn't like about the company, so it's selling off dramatically, which makes you think, okay, maybe I should wait. I can get it for 50 the next week. And if you do that and it goes to 50, you're just going to keep saying, no, I will wait. It will get cheaper because it feels so intense in the moment that it's happening. If you have experienced a bear market before, it always feels like it's scary. So you kind of keep waiting. And then the next day you were waiting for 50, but then the next day it goes from 50 to 55. And then you will start saying the other thing, it will go the other way around, you know, you start saying, it's a fake rally. Wait, yesterday I could get it for 50, now it's 55. I will wait a little bit more, it will get cheaper. And all of a sudden it's at 70 again and you lost your opportunity. That always happens, and that's why I don't really care about the short-term prices. So if I have a price on a specific company that I like, I'm just going to buy. And if the market gives me an opportunity to buy lower, let's say 10 or 20% lower, then great. Because as I always say also on your Discord, if you love the stock or if you like the stock at 60, you should love it at 50. But most people get scared when shit hits the fan, if I can put it like that.
Yeah. Yeah. So if you pick a winner, then that's a great story. But like, yeah, people need to really investigate and know what you own, because like is
Absolutely.
Walgreens have Walgreens bottomed out yet, or it is like
No, no.
90% down? No, yeah.
Yeah, exactly. It's always a company specific case. And when you see a company or a stock fall 30, 40, 50%, you need to, you can't just assume that it's going to go back up. You need to assess why is it dropping so much for sure. You need to do that.
Yeah.
One way I would like to look at it is actually when you compare the stock price to the company's fundamentals, because these two don't always follow each other. So the case for REITs big tech in 2022, the stocks were sold off 30%. Like some of the big tech, Microsoft, Apple, all of these companies, strong companies that was sold off 30-40%. But the earnings didn't fall 30 or 40%. So that's kind of a dislocation in my view. And if I can run that through my investment thesis or calculation and the numbers make sense, then I see it as a great opportunity. So I try to look at the stock price fall and see if it's just way overdone compared to what has happened to the fundamentals, if earnings are going up still.
You have
Which was the case for, yeah, sorry, go ahead.
no, it was just to bring another example. No great name are immune to a down cycle. Just look at the former dividend king Stanley Black & Decker. They were almost trading at $200 a share in 2021, and is now around 90, the high end of 90, and they have kept their dividend. It's around 3.8%, but their payout ratio is 300%, and they have almost doubled their debt in 2 years. That's a catastrophe awaiting to happen.
Yeah, that's scary.
Yeah, absolutely. It's very tempting to think that a company will last forever, especially when you're looking at those dividend aristocrats or dividend kings, because they have hiked their dividend for 25 or 50 years, which is a long time. But the world is changing and the market around those companies is always changing. So the companies need to adapt, and this is not a given. So yeah, no company is immune. I agree with that.
Yeah, so in respect to Stanley Black & Decker, I haven't looked at that company in a while, but I can imagine that most of it is due to, that they had some issues with competition, right? That there have been others that have taken market share. So how do you go about looking into the competition? What do you typically do?
Sorry, I lost your first sentence. Which company were you talking about?
The Stanley Black & Decker,
Okay. Yeah.
those company.
Yeah. Um, yeah, so your question is just in general when I'm assessing the competition of a company, right?
Yeah.
Yeah. So it depends on if I know the space or not. If I already know the space, either through personal experience in my everyday life, or not, then I would know who the main competitors are. But just Google it. Just do some research. Try to like find out who are the big players in this space. When you're looking at a company, find out what sector this company operates in, and just do some research. Google who are the big players. I always try to focus just on the top three. I always have this thesis in my head that the strong will get stronger over time. It's not always true, but I like it. So I always focus only on the top three.
Yeah, I think that's a really good advice. And how do you determine who's in the top three? Like market cap or revenue
Market
or?
cap, yeah, market cap and revenue as well. It could be both. I know we're going to talk a little bit about cybersecurity today, where you have an example of CrowdStrike being bigger than Fortinet in terms of market cap, but Fortinet is bigger in terms of revenue. So, yeah, I look at both things to see who are the dominant players in terms of revenue, like who are the biggest, who's actually selling stuff here and making some real business, and who are maybe up and coming, like in the case of CrowdStrike, whose shares have been just going up dramatically because the company or the market is expecting a lot of growth ahead. So I will try to determine what differentiates the two or the three in the top three, and see if I can make some kind of assessment on the company that I'm analyzing. Where do they stand and how are they going to do in the future compared? But I prefer to go for the best in each sector, because yeah, I think times have proven before that um, the big will get bigger, and it's just when you're a big company in a sector, or the biggest company in a sector, you just have some advantages that smaller companies don't, among financial flexibility and strength to make acquisitions and to grow, which has been the case for big tech as well. All these capital resources they have, which they can put in research and development, it's a big advantage compared to smaller startups who are desperate for capital. It will give them an edge over competitors.
Yeah, that's a really good point. And the startups are very vulnerable if, in a higher rate environment, that they won't get the necessary funding to keep going, and then they get bought
Exactly.
out.
Yeah, that's why I love the big tech drop in 2022, because all of them are cash flow independent. They're not in need of external funding to grow their business. They have so much free cash flow they can reinvest in the business, so they can pretty much do whatever they want without seeking approval from banks or investors in
Yeah, I think
terms of
that's a really, really important point, because we had some capital. But there's a lot of people got burned today in Norway from somebody that they got money last night from investors. It was
Yeah,
a 97% discount to closing price. But we don't
yeah,
we're not going there. It's just a very important point that, like, the
it
company needs
is.
to stand on their own feet.
Yeah. Yeah, this is exactly the reason why I can only invest in companies that I think have a strong financial position, because I've just seen multiple examples before of this strong and flexible financial position giving this company some advantages over the others. So let's just quickly just touch on the AI theme that is going on at the moment. How are some of the smaller companies going to compete with Microsoft, with Amazon, all of these companies, with Meta, when it comes to large language models? These companies are so massive and putting so much money to work. It's just like a cheat code, to be honest. But yeah, that's why I prefer these strong financially companies.
When you touched upon the big tech companies, do you see any value out there among the top 7?
I guess it depends on what kind of hat you want to put on when it comes to AI. Do you believe it's going to be accretive to earnings over the long run, or not? Because if it is going to be as big as some of the analysts or market experts are expecting, then I think over the long run you could obviously make some money even from buying today. But I think in the short term, these companies are fully priced. So it's not something I would be looking to add at the moment. I will definitely be waiting for either a correction or some clearer, um, a clearer vision on AI and the capital expenditures that they're going to have over the coming quarters, because they're already using a lot of money on CapEx to grow. And so far, they have had little to show for it in terms of earning from AI. So
Like Amazon, for instance? Don't you find any value there?
I don't, and Amazon specifically has always been a stock that I would avoid. I've never owned it, and I never will. The reason for that is as I mentioned, I like strong financial positions. And when I look at the balance sheet of Microsoft, of Apple, of Meta, I just see a much stronger company than Amazon here. But obviously, Amazon is massive and they have done amazingly over time. So I'm not saying at all that it's not a good company or could be a great investment over time, but I just don't like the lagging free cash flow. Obviously, at the moment, they're actually growing their free cash flow, which is why the company has rallied so much recently. A lot of the analysts are saying that it's going to be very, very cash flow producing in the future here, because all of these investments that they have made over time has finally begun to give some benefits, or to, what do you say, like to yeah, to harvest the fruits from that. But the retail business is a big part of them, part of their company, and they're not making that much money on that. I'm not even sure they are making money on it. They're making most of their money on advertising and AWS, the cloud service. which is also a very competitive space. So for me, it has just been a pass. I've never invested in it. I don't fully understand the company and what it does. I'm not on board with the vision for the future of the company. So yeah. Also, the company's earnings are much more volatile and unstable compared to some of the others, and this is something that I appreciate. So my focus will always be on steady growers.
But Alphabet and Meta did announce their first ever dividend this year. Don't you think they will be the next aristocrats?
You should never say never. I think it's possible for sure, but especially in tech, the world is changing so quickly. So you never know what kind of technology or what other companies can come up and take over some of their business. At one point, Alphabet was the stock was selling off dramatically because of OpenAI and ChatGPT. The initial words on that subject was that this could be a threat to the existence of Alphabet. If we could just ask a question to a chatbot and we will get an instant answer instead of looking through links and articles on Google, and maybe not even finding what we're looking for, we would get an instant answer from this AI chatbot. I think at the moment it's not a threat, but I don't see any reason why it shouldn't be in the future if the technology advances well, and and the search world will be much more efficient. You never know what's going to happen. So I think they have the position to be able to be a dividend aristocrat because they're such massive companies, but I will never be fully convicted that it is a certainty because in that world, in tech, things can change very quickly. You saw it with Meta as well. When the stock price fell 70%, it was a massive drop when you look at the market cap as well. And there was multiple reasons for that, but one of the main reasons was TikTok and the advancement of TikTok in the US and in the West. I don't know if you guys remember that. That was actually the market, or the investors were actually worried about the existence of Meta, and could they pull it off? They were losing users to and eyeball hours to TikTok, so that was a threat at that point because TikTok kind of changed the way people were viewing content on social media, where Meta's previous algorithm was social based. You will see on your feed, you will see pictures and information from the people you know. At that point, TikTok came up with another algorithm which was more interest based. So you would get content from people you didn't know based on what the AI algorithm had spotted that you liked. So if you search fitness videos, it will start to show you fitness videos and users profiles from people you don't know. It kind of changed the game a little bit there, but Meta have obviously come back quite well in that case. But yeah, just goes to say that you will never know what happens.
Yeah, we went through that roller coaster ride together, and
Yeah,
the thing is, we both had high conviction that Meta would pull it off regarding Reels, that they worked really hard on kind of making up for the TikTok growth to keep their users active on their platforms, and they pulled it off. So Meta adapted, and the rest is history, as the cliche goes. But
yeah.
there were a huge amount of cash burn on the metaverse as well, which hasn't brought any positive earnings or any growth to the owners of Meta stock.
Absolutely. It has been a massive cash burn over many years now. And I think it's just a stupid goggle project of some billionaire called Zuckerberg. It's his own project. I don't think it's going to play out in the real world at any point. And at one point, I think they will probably lose it, like just dump the project because they will acknowledge that it's not going anywhere. But I also think, to be fair to Meta, I think it's being discounted in the multiple that you're paying for the stock. I don't know if you guys have noticed, but it's always trading at a lower valuation than its peers, like Google or Alphabet or Microsoft and Apple. Meta's always trading at a lower multiple than that, and I think that has some part to play in the multiple.
But haven't both Alphabet and Meta actually been trading at the lower multiple the last 2 years? If we're going to be fair, Alphabet has shown stellar earnings, and it's trading for a forward on a forward PE basis on 2022, which is actually kind of, I won't say cheap, but it's reasonable. And let me just check. Meta is actually higher, 25 forward PE. Don't you think it's the market saying they think the ad space is going to be weak sometime ahead?
It definitely has a say in the valuation of the company. I think at the moment, I don't think we're going to that route here, but I think there are some divided signals in the market in terms of recession or not. Some investors are pricing in a recession, and with that comes lower ad spend, and some investors are more optimistic. But I think I agree that lower ad spend or just a weaker ad market in general is being priced in at the moment.
Yeah, so but we could probably here transition to something like a recession would probably mean lower rates, and that would fit perfectly with your thesis, Mudsen, on REITs, right?
In the short term, it would, yeah. So just as rates were hammered in 2022 because rates were going up, the reverse is going to happen at the moment with rates going down. The beginning of a rate cutting cycle will definitely benefit REITs, that's for sure. But actually, there's
How?
a common misconception. Yeah, go ahead. Sorry.
No, go ahead.
I was just going to say that there's actually a common misconception when it comes to REITs in terms of higher rates. Because as I've written a couple of times on your Discord channel here, it depends on what kind of REIT you're looking at. But if you're looking at, for example, Realty Income, the way they make money is by an investment spread. So if their cost of capital is 5% and they're buying properties at a 6% cap rate, that's a 1% spread, which means they will make money. So when rates go up, in the short term, it will harm REITs, which it also did in 2022, because the refinancing cost will be higher, and at the same time, there hasn't been enough time in the property market, like in the real life market, for sellers to adjust their expectations. So it takes about a year before this expectations adjustment will happen. So when rates go up quickly, as they did in 2022, the property sellers will still think that it's temporary. They will still think that their property is worth, let's just say, $1 million. Well, when in reality, because of the higher cost of capital, this property needs to be adjusted on the price to the downside, which will give a higher cap rate to compensate for the higher cost of capital. Does it make sense?
Yeah, makes sense.
Yeah. So in the short term, higher rates will affect REITs because of higher refinancing cost and the lack of price adjustments in the real market. But let's just say everybody, buyer and seller, agrees that okay, this is the new rate level. 5% is the new cost of capital. We need to adjust, otherwise we won't get a deal done here. So even if the rates are 5% for a long period of time, after about a year or so, the property prices will adjust and the cap rates will go to 6 or 7%, and they will again reclaim this investment spread. So yeah, in the short term, this is also when the rate cutting cycle is going to begin at the moment, probably. It will benefit them because of the cheaper cost of capital. But again, after about a year or so, the property prices will adjust and the prices of the properties will go up again, meaning the cap rates will go down So the investment spread will always be about 1 to 2% in the long run, regardless of what the rate environment is looking like. But when you see a big adjustment in rates, like we did in 22, and we're probably going to see over the next year or so, it will, on one side, harm REITs in the short term, and on the other side, it will benefit them in the short term. But over the long run, it doesn't really matter.
Yeah, that's very good points. And in the downturns or when rates go higher, and you have a lag between the property values come in harmony with adjusted levels, then in that situation, the weak REITs will struggle because they we won't be able to have access to new capital to buy cheaper properties. But the stronger with access to capital will get a hold of cheaper properties and can earn a little bit more for some years.
Yeah, exactly. And this is also just in line with what we talked about before with the strong getting stronger. So especially with REITs, because they're such a leverage company, or they are leverage companies, and that's how they grow their earnings by taking on leverage. It's very, very important that you look for REITs that are not over leveraged and can sustain a period of higher refinancing costs.
If I might add, one more factor to consider is when the small REITs, which are highly leveraged, when they have a downturn, they will always have to sell their golden goose first because nobody else is buying. So it's exactly like Mudsen said, the bigger gets bigger and the stronger gets stronger.
Absolutely, because as you just said it perfectly here. The weaker, smaller could be, but also just in general, small or big, the weaker will struggle in hard times, which means they could be forced to sell some of their core assets to be able to deleverage and pay their obligations. And that often means that some of the bigger or some of the stronger REITs can benefit from that or take advantage of that because they will get a great asset at a discounted price because of this seller being in desperate need of capital. So what tends to happen is that the strong REITs emerge from crisis even stronger.
So, do you own some of the REITs, or do you find any of them reasonable priced given their run up the last couple of weeks and months?
Yeah, so I own Simon Property Group, I own Realty Income, I own Agri Realty, and Vici Properties. Those are the four REITs that I own. It's different from REIT to REIT, but in general, I would say that most of the REIT, the run up that you're talking about has taken some of the discount out of the equation here. So I think in general, I would say there's about 5 or 10% more upside to fair value levels. So it's not a big bargain anymore as it has been over the past year, but still a buy. A very quick and easy way to assess whether or not a REIT is going to provide you with the returns that you're expecting or that you desire is actually just to look at the dividend yield and assess whether or not it's safe. So let's just take Realty Income as an example. If you think that the dividend of Realty Income is safe and it's not going to be cut, then at the moment I think the dividend is around 5.2%. And then you look at how the AFFO per share is going to grow. REITs have very stable cash flow, so if the AFFO per share have grown 3 or 4% over the last few years, then most likely it will continue to do that, because they have like this built-in rent escalation of 1 to 2%, depending on what REIT we're talking about here, which is the internal CPI linked growth. And then they do acquisitions of another 2%. So if you say that 4% AFFO growth, combine that with the 6% dividend yield, then you will have, all else being equal, a 10% return. Because the multiple or the earnings are growing 4%, and the multiple, if that stays the same, combined with the dividend, you will have a 10% return over the years. So that was actually one of my main ways to assess whether or not REITs were a buy. And I bought a lot of REITs when they were all yielding 6% or more over the past year. Because I saw the stock prices were just going down. And if you look at those specific REITs, all of them, the four of them, the earnings did not go down. So there was a big dislocation there as well. Earnings were going up, but the stock price was getting hammered. And at least for the four REITs that I own here, the dividend is very safe. So that was the calculation I went with, and I completely believe in and trust.
Yeah, that's a sweet divergence. So, okay, we can go transition over to some cybersecurity. We had some questions regarding Fortinet. That's a position you've had for some time, I think.
Yeah. I own actually only a small position in Fortinet, but I have had it for a couple, maybe 1.5 years now, I think. And the reason for the small position is one of the things we were talking about earlier, which is know what you own. So I think I know I have a basic understanding of Fortinet and the market they operate in, but I don't have the technological knowledge on the products compared to the competitors, and also the cybersecurity space is very, very innovative, which means it can be rapidly changing, and this is a risk that makes me want to take smaller position sizes here, which I have done. But I do own it, so if I could give you a little bit of my bull case for Fortinet, then here we go. So cybersecurity is actually a sector or industry that I think are going to do great over time. It's in what is called a secular bull market, which means that the market overall is growing. The total addressable market is growing. So it's a great place to be because you're not trying to invent new growth in the market as a company. So Fortinet are not trying to invent growth. It's just coming from the overall market expanding because the pool or the pie is getting bigger. Um, I think cybersecurity is part of what is called a megatrend, and that is digitalization. So as the world is getting more digitalized, cybersecurity will benefit from that. The need for data protection will become bigger, and I actually always call data the digital gold. And you need to protect it the same way you would protect physical gold bars from bad actors. Yeah, so this is kind of my sector thesis here, that cybersecurity is here to stay, and the need for cybersecurity will grow over time as the world becomes more and more digital. You've seen, I don't know if you guys remember, but United Health had a cyber attack not too long ago, which kind of damaged their stock price. You have some governments as well trying to do whatever they can to protect data and critical infrastructure from cyber attacks. So cyber attacks is a way of war, if you can say it like that, a way of warfare. It needs to be protected. The data needs to be protected from bad actors, even individuals as well. So yeah, that's why I think like fundamentally the need for cybersecurity is going to continue to be strong going forward. But if you look at Fortinet as a company specifically, it is one of the leaders in the space. You have like the three big ones, CrowdStrike, Palo Alto, and Fortinet, with Palo Alto being the biggest in terms of revenue, but also the biggest in terms of market cap. And you have Fortinet number 2 in terms of revenue, but number 3 in the market cap. And the market in general, cybersecurity market in general, is actually, there's a trend on the way at the moment, which is going towards a more cloud-based infrastructure. If you have heard some of the interviews done by Palo Alto CEO Nikesh Arora, he always talks about platformization, which is the next big thing that Palo Alto are focusing on. It means that it's kind of like a one-stop shop for the companies using the cybersecurity products. So you go to Palo Alto, you say, I want it to be secure, and you can get everything you need from Palo Alto. But that's not the way it works today. You can have like network connectivity, network security, firewalls, all of those kind of things from Fortinet, but you can have security from other companies as well, and you have to like kind of stitch it up to make it compatible. But the trend is on platformization. The trend is towards this cloud-based platformization, which is actually expected to grow at, I think it was about 18% CAGR over the next 4 or 5 years. And the total addressable market in general for cybersecurity is expected to grow 55% over the next 4 years. So yeah, the pool is getting bigger, as I mentioned, and the Fortinet being one of the leaders in that space is going to benefit a lot from that. And especially what I like about Fortinet actually is that it was founded back in 2000, but the two co-founders at that time are still there. One of them is the CEO, and one of them is Chief Technology Officer, so the CTO. And both of them still own about 15% of all the shares outstanding, which is kind of rare. You don't see that too often, but they have skin in the game, as you would put it.
Yeah,
Yeah,
I like that. That's
yeah.
important, and in such a tech-heavy company, that's great that it's the CTO that's been there the longest.
Yeah, it's amazing. And if you compare it to in terms of like the product they have, they are highly diversified business actually. They have like both small, medium, and large enterprises, but they're also in more than 100 countries geographically. Um, and that's why I think that at the moment they're one of the best when it comes to hardware, but they are only what is called a challenger when it comes to the cloud-based infrastructure solution that is going to be provided in the future. It's growing at the moment, but they're not the leader in that space. That is Palo Alto. And the way I get this information is actually there's a company in the US called Gartner, which is kind of like a research firm for technology. They have like 5 criteria that they assess cybersecurity based on. As 5 criteria for cybersecurity, where they try to put all the companies in that space in 4 categories. And 3 of those 5 categories, you will find Fortinet being the leader, which has all to do with the network connectivity and just like general firewalls that we know from many years ago. But the new trend in cybersecurity is this cloud-based infrastructure, and here they're only the challenger, with Palo Alto being in the lead. Yeah. And
Yeah,
as I also touched upon before, the balance sheet, it's amazing. They have a very low stock-based compensation, which is something you would typically see as being very high in these kind of companies. But because the two co-founders have a lot of shares themselves, they are very wary of stock-based compensation. So as a percentage of revenue, it's very small compared to their peers.
yeah. Without naming any names, it's quite high in some of the others.
Yeah, there is like if you take, I think it's 5% of revenue was stock-based compensation when we're talking about Fortinet, but for Palo Alto it's 14%, and for the peer group it's 22%. So you will see a lot of shareholder friendliness in Fortinet, which is one of the reasons why I picked it. And in general, actually, the market is very fragmented, as you would put it. So you have a lot of companies, but many of them are small. So I think Fortinet is going to go the route of acquisitions when it comes to catching up to Palo Alto in the cloud-based solutions, and you will see more consolidation in the sector for sure over the coming years. And again, we're back to the quote from before: "The strong will get stronger." You have Palo Alto, Fortinet, and CrowdStrike. I think they will continue to grow, and they will eat up much of the competition that is coming their way just by having the financial muscles to flex and do some acquisitions that could benefit their business.
Yeah,
So that's why I'm
as
not
long
too
as
worried about them. Yeah, I'm not
yeah,
too worried about them being a challenger because there's room for more than just one company in that space, and I think they will be there in 10 years as well.
yeah, and the integration part of it, it's probably like okay platformization, but there's probably a little bit work to change to have some switching costs.
Yeah, for sure. Actually, if you listen to the recent interview from Palo Alto CEO, he talks about just what you touched upon here. The switching costs are too high. So the trend is going towards platformization, which is a one-stop shop for companies. So when a company decides to go with Palo Alto for their security needs, it will be impossible to switch because they will be deeply embedded with Palo Alto here. So once you get these customers on this platform that you're building here, it will be a long-term relationship that will be very, very difficult to get out of from the customer's perspective, but great for Fortinet and Palo Alto.
Yeah, as long as they don't accidentally shut down the world economy with some some updates. But yeah, we could.
Yeah.
It would be interesting to go over to another subject, like with you have this switching cost issue as well, that you don't have any any other option, and that would be the railroads. We had some questions about that. Have you looked into that sector?
Yeah, I own Canadian National Railway as the only company in that sector. And actually, I see it as a kind of like a defensive anchor in my portfolio, because it's just stable. You don't just build a new railway, just as you were talking about a minute ago. It's impossible to switch. New railways don't just get built, so they have two railroad companies in Canada, one of them being Canadian National and the other one being Canadian Pacific. I own Canadian National. But this competitive situation there makes for kind of like guaranteed cash flow for years to come. So the reason I own it is just for a stable and cash flow providing a defensive anchor in the portfolio. And a lot of people actually don't know, but rail transportation is actually the most fuel efficient mode of transportation, and one of the cheapest as well, due to the capabilities of having large freight and large commodities in this like in your freight train. The one freight train is actually equivalent of 200 to 300 normal trucks. So it's a very cheap and fuel efficient way. So if you're focused also on the environment, this is one of the best transportation modes when it comes to the environment compared to trucks and planes and ferries. Yeah, and for CNR or Canadian National in general, one of the other reasons why I chose the company was due to its train network reaching three coastlines. So they have like a coast network or a train network that stretches from the West Canada to East Canada, but also all the way down to the south of the US near the Gulf of Mexico. So it's a very large area, which is connected to many parts of the world. So you have like Asia on one side, you have South America on the other side, and Europe on the third side. So I just think it's a great moat, to be honest.
Yeah, I've looked also at those maps. It's pretty impressive what they've been able
It,
to do there.
yeah, exactly.
Okay,
So
so
yeah,
okay, so you touched upon like freight, like sea freight also. We had a question about DSV. Did you own that?
I do own DSV. Yeah, I own that in my not in my retirement account, but in my normal account, as I would put it. It's a small position, but I do own it. And to be honest, at the moment, there's not much to say about the stock because it's kind of like in a sit and wait mode. The market is waiting for the decision in terms of acquiring DB Schenker. It's a massive acquisition if it happens. It will solidify their position as this global giant in the logistics space. But it is a huge acquisition. I'm not sure. I think it's the biggest they've ever done, actually. They did quite a few big ones in the past as well, but I think this one is the biggest. And at one point, the stock was actually trading at very low multiple because the market was afraid of this acquisition. like what was it going to mean for DSV? Are they going to be able to integrate this new company to the existing company and create these synergies? What about the price? Because the price that is being talked about at the moment is about 15 billion euros. And if you look at the balance sheet of DSV, there's no way they can fund this acquisition without asking shareholders for more money. So the market has been kind of selling off the stock and waiting for clearance about this subject. And recently, the stock has actually gone up a lot because of two of the competitors for this acquisition have gone out. So now there's only two left. So there's DSV and then one more capital fund. I think it's from Saudi Arabia, which are the two only ones left in the race of buying DB Schenker. One of the big reasons also for being negative towards this acquisition is because DB Schenker is owned by the German government. And one of the ways that DSV in the past have had great success in acquisitions has been to put it out there, just to fire people where it did make sense, and to kind of like lean down the new company and integrate it to the existing one. But with the German government owning the DB Schenker at the moment, what are they going to say about this recipe that DSV has used in the past? Because they don't want their population to be fired, So the market has been kind of confused and not too sure about what to think about this acquisition because of the terms that it could come at, both in terms of creating synergies, but also at the price. So let's see what happens. There's a expected closure here in Q3 actually, so we will be smarter about this subject soon.
Interesting. Yeah. Okay. I think we'll go to the final subject of the day. I've been waiting in in anticipation. You touched on the stock earlier. The ATD, the convenience stores. They also announced a big potential acquisition lately. Have you had the chance to look into it?
Yeah, I did. And actually, when I saw the news about them putting an offer for 7-Eleven, I was kind of happy as a shareholder because I think it's just an amazing opportunity. And it's just in line with the ATD vision. They will, if it happens, and this is a big if because there's a lot of things that could go wrong here, and it's still very, very early. But if it happens, it will really help them in their presence in Asia, especially, but also in the US, where 7-Eleven is kind of big. Yeah, but in terms of, or like for ATD in general, I think I mentioned the stock earlier in this podcast here because of the stock chart. To look at it, they have just done an amazing job over such a long time. They have built a successful business on a acquisition model. That's how they operate. That's how they grow. And this has created a lot of amazing shareholder value over the years. ATD is actually one of the companies where I would say that there's no reason to kind of babysit the stock, if you know what I mean. They are great operators. They have shown this time and time again. So especially because it's a small position for me, if it was bigger, I would probably do like keep up a little bit more. But I do read the like the basic news that comes out from the company. But my view on ATD is just let the company do what it has always done, which is grow through acquisitions and creating synergies, because they have done it amazingly over time and they will continue to do that. I think they have like a great integration framework, so they can apply this to their acquisitions. I kind of describe it as like a copy paste model. There are some differences depending on what markets they're operating in, but a convenience store is quite a simple business, to be honest. Not a lot of things goes into running a convenience store, especially not when you have the setup as ATD has, like supply chain management. But when you're talking about convenience stores, there are some differences in terms of which market you're operating in. This could be in the product mix, but also, especially actually in wholesale activities, which means the sales that are going directly to business customers and not to the retail customers that goes into the store. So an example on this would be large amounts of fuel, like bulk purchases. I think one of the questions was also in terms of valuation, right?
Yeah.
Yeah. Maybe Farag will agree with me here, but I think the current stock price is too high. I think it's around $81 at the moment. And when I run it through my valuation model, I would prefer to buy it below 70. But the problem here is that the stock rarely gets sold off. So you need to find a price that suits you and then initiate a position. And if it falls further, then great, you can buy more.
I totally agree. It's trading at forward P at 20, and it's above the historical average. They have the fundamentals haven't changed. They have gotten a new CEO, which have been in the company for an eternity. So I think the culture will sustain, and I think they will succeed with the M&As going forward. But I totally agree. I bought it at a pullback earlier this year, and the thing is, uh, I think if they get the deal with 7-Eleven Holdings in Japan, I think you will get a really good positive synergies because they ATD is known for maximizing profits, and 7-Eleven has quite poor execution on their or not quite poor, but more ATD is doing better at executioning their product line and portfolio and how they set up the stores. So I think I think this will be interesting, but I don't think you will get the green light before the end of next year.
Yeah, it can take a while, but I completely agree with you as well. Like, I think they are strong operators and they have done amazing over time, and I think they will continue to do so. To be honest, I actually think that ACD will be a multi-bagger over the next decade from today's price as well.
I I
There,
think so too. I think so too.
yeah, they have such a great runway for growth ahead of them. Because even though it's a big company, there's just so many more acquisitions they can make in the US and other places as well. But especially in the US, the market for convenience store is very fragmented. You know, you have a lot of like single standing convenience stores that are not a part of a big chain. So there's a lot of room for acquisitions in the US, but also other places like Asia. So I think the growth runway for HAD is still quite big, and I can see them expanding a lot over time.
I heard from one of the analysts in Canada working for Royal Bank of Canada.
Yeah,
I had a chat with him on X, and he was wondering what we Norwegians actually thought about the ATD stocks, and then we went on talking about it for a couple of weeks back and forth, and he said that he thought that ATD will get really aggressive and offensive on their M&As going forward the next couple of years. Uh, um, just one of the things you mentioned, uh, the North America space is so fragmented. There are a lot of publicly traded and private chains that needs to rebuild and restore and has to get new breath. And ATD will go and buy them. I'm quite certain of it. And he thought that a couple of stocks like Casey's and Murphy USA, which is also one of my holdings, have a huge run up. Is not just because they are doing well fundamentally, but there is some speculation in the market that ATD will acquire either Murphy USA or Casey's. And if that's gonna happen, or if it goes through, the profit margins of ATD could easily double. And if they easily double, well, then the stock price is really gonna run up in the years heading forward.
Absolutely. So no hype from me, but I strongly believe it will be a multi-bagger over the next decade for sure.
Mm.
Yeah.
But
But
yeah,
as I
we're
mentioned in
not
the
giving
beginning,
financial advice.
no,
Yeah, but Mudsen works for the bank, you know.
Yeah, that's true. That's true. You're actually certified,
yeah,
aren't you?
yeah, that's true. But as I mentioned in the beginning, when we talked about ATD, the stock rarely gets sold off. So I would just wait for a pullback and initiate a position. Just find an entry level where you will be satisfied, and then just buy it. If it falls more, then yeah, go for it. Double down on it. Waiting for like 30 or 40% correction with HDD, I don't think it's going to happen. So yeah, a small pullback, and I would initiate a position, maybe around the 70 area if it happens. But it was down there recently, so I'm not sure it's going to happen anytime soon. But let's see what happens.
But why didn't you add more to ATD if you have such a high conviction of the company's fundamental and the story? Why haven't you bought into that narrative?
Yeah, I only bought it once actually. It was in the low 60s when I bought it. And I can't remember like on the top of my head now, but Um, I'm pretty sure I bought another stock or other stocks at that time where HED was pulling back. Did it reach 70? I think it didn't, right? It was only went to like 72 or 3 maybe. And I was expecting or like hoping it would get to 70 before I would average up. So my average is in the 60s, low 60s, and I prefer to buy it in below 70. But I don't think it ever went there. Yeah, so my eyes were elsewhere at the time. But yeah, there's absolutely no hype from me. I think it's a great stock and will do very well over time.
Excellent. So yeah, I'm at the end of my questioning or questions. Um, Anything else, Farooq?
Yeah, I think there is one question you forgot to ask, and how does Mudsen exploit the market fear? And Mudsen, what did you do around the 5th of August when the Nasdaq opened 6% down?
Yeah, with the yen carry trade, I didn't do anything to be honest, and this is because my like macro thesis is that we will have a recession, and at that time, I was I had some serious doubts on whether or not this could escalate to provide even more volatility and more downside. So I didn't pull the trigger on anything at that time. Also, I think the market overall is a little bit stretched when it comes to valuation. So a 6% drop is not enough for me to, like sit and clap my hands. Yeah. So I didn't do anything. But when you were talking about like market fears in general, I would just say like just have a plan beforehand because corrections always happens. It happens every year, sometimes small, sometimes big, but they occur often actually. So don't let it catch you by surprise. Have your watch list ready, have your entry price on the stocks ready before it happens because when it happens, you will be prepared. But most importantly, I think when it happens is um, not letting the psychology get to you. We talked about it before. If you keep waiting for a better and better price because it seems so scary in that moment, eventually it will turn and then you will get greedy and say, oh, but it was 50 yesterday, now it's 55. I will wait another day, maybe it will come back down, and then it's 60 and then it's 70, and you will lose your opportunity. So don't get greedy and just buy when you think the price is right. If it hits your level that you have prepared beforehand, then you buy. Otherwise, I think people will end up waiting and waiting and eventually missing the boat. And people got to remember something, which is that a famous quote that I like a lot actually, but it goes something like this: "Money is made during bull markets, but fortunes are made during bear markets." And if you look at a long-term chart, every major crisis in the past has been a massive and great buying opportunity. It feels scary in the moment. It feels like the world is coming down and everything is just going like to shambles. But people, the market and the world and the economy will grow again at one point, and at least that's what history shows. So these big pullbacks have always proven to be great opportunities, and you have to remember that when it happens. So yeah, I didn't sell my wife during 2022, but she was next in line. So I was kind of like accumulating a lot of capital from anywhere I could get my hands on capital from, and then just buying the dip in big tech. Um, that's what I would do. Yeah,
Listen, guys, this is our legendary go-to Mudsen. Thank you so much for attending, and you're always a pleasure talking to. I've learned a lot, and we know each other really well, and the thing is, you keep it keep it stupid simple, and that's the key to succeed within the investing journey that we all try to strive for to gain our financial freedom.
absolutely. No need to complicate things because investing is a big world, but it is quite simple to be honest. Just keep your emotions in check and focus on quality. How does the saying go from Terry Smith? The 3 points, remember that? What is it? Buy great companies at a fair price and do nothing, something like that. And it's so true.
Yeah, it is. It is.
Yeah,
Yeah, thanks for coming on, Mudsen. It's a great ending to the show, and yeah, we wish you the best of luck in your endeavors, and hope you will come back
of course,
sometime
guys.
soon.
Thank you so much. Of course.